Well, the last 72 hours have been very trying for the US banking system and indeed for global financial markets. We saw the fall on Friday. This morning, India time, and of course, in the US, Sunday night, the Treasury and the FDIC announced a decisive support for depositors of two troubled banks, Silicon Valley Bank and Signature Bank. But of course, no support for bondholders and equity holders in these two banks. Now, Dow Futures has since then jumped about over 300 points on this announcement. Asian shares and Indian shares also are in the green. But there are still some doubts. As you can see, the Indian shares also have receded. Some doubts over how the US banking sector and the Fed's rate hiking trajectory will play out. For all these issues, I am joined by Robert Sockin, the global economist at Citi, joining me from the United States. Robert, thank you very much for staying up for us. That's really kind of you. Now, first, does the FDIC and Treasury action reassuring deposits end the banking instability for now?
That's a great question, and thank you for having me. I think it was an important step, and we'll see how market volatility plays out in the coming days. But our view was that the challenges at SVB were probably idiosyncratic, and that the broader banking sector in the U.S. Already remained very healthy, especially if you look at some of the larger institutions. They have very high capital ratios. They have to go through an enormous amount of stress testing from the federal government. So our view always was that the banking sector was in pretty solid shape. But I think the government coming out and with their important moves to basically backstop the depositors, I think will probably go a long way in quelling any fears that people might have about the health of the banking sector, big or small banks. So I think it's a step in the right direction. We'll see how market volatility and market price reaction plays out over the coming week, but I think it was a very important move.
Oh, yes. Depositors should be reassured and shouldn't be creating a run on other banks. But now the more important question is, what's the impact of the collapse of the two banks on the Fed's rate hiking trajectory, you think?
This is a great question, and I think for the Fed, you have to think about three factors here. One of which is the market volatility related to SVB that you highlighted. But first, I think it's the labor market. And last week we saw a very strong headline payrolls print of over 300,000. And that's way above the type of job growth that the Fed wants to see right now. They really need to see a slowing down in the labor market. You did have some uptick in the unemployment rate, but most measures of slack remain very tight. And given what we're seeing in payrolls, I would expect the unemployment rate to fall back down in coming reports. Wage growth was a bit on the soft side, but that could be a compositional factor. We'll see how the Atlanta Fed wage tracker comes in, which controls for composition, how wage growth looks there. But I would say right now, the evidence after the jobs report is still in support, in our view, of a 50 basis point hike in March, although there are some factors that could argue against it. The second factor, again, is SVB market volatility. Up at the margin, this may go into the Fed's thinking. It depends how broad of an issue it became and how much the market volatility stretches throughout March. But I think the actions over the weekend are going to really mitigate that effect. And so, if what I'm saying is correct and that the market volatility really calms down from here and fears about the banking sector subside, I think that's going to be a very marginal factor in the Fed's March decision. But of course, again, it depends on how that volatility plays out. And then the third factor is, of course, what happens with inflation that we get this week with the CPI. We're looking for a very strong core print of 0.46% month over month. So that's rounding to a 0.5, with still very strong price pressure in those services sectors. So I think when you combine that, still strong jobs growth, still hot inflation, and the banking sector issues are probably going to move more to the background, I think that still sets up the Fed for a 50 basis point move this month. and probably signaling that the terminal rate is going to be higher than they previously thought.
Okay, 50 basis. You know, Robert, the FedWatch, CME FedWatch tool is now showing that markets are beginning to pencil in only two more rate hikes, only one on March 22nd and one in May. Now, what's Citi's expectation about the terminal Fed funds rate? Does it change in the light of the banking collapses?
Yeah, that's a great question. We have a terminal rate of 550 to 575. And importantly, we still expect the balance of risks of that to be to the upside. So not only do we have a 550 to 575, but it wouldn't surprise us if the Fed had to go even higher to that, to even something in 6% or higher. And again, that really comes down to a still very strong labor market and really strong inflation pressures, particularly in those services sectors that are very tied to the labor market. Again, as I said, it really depends on how much of this banking stability issue spreads and how it plays out in coming weeks. But given that I think SVB is probably idiosyncratic and that the broader banking sector is healthy, that really, I think it's going to come down still for the Fed to these core issues of what is the labor market saying and what is the inflation rate saying. And their number one goal is to bring down inflation. And with risks there still to the upside in our view, we're still pretty comfortable with that 550 to 575 range as our base case, and still see, as I mentioned, upside to risk that could go even higher.
Okay, now that's a very different point of view we got from Goldman Sachs. You think that SVB is idiosyncratic, the banking sector is healthy, and the Fed will be governed by the inflation and labor market. Now, if your expectation is a terminal rate of 5.5 to 575 and with an upside risk to 6%, what does it do to growth, especially in the second half of this year?
Yeah, and that's the real trick for the Fed right now is they have to figure out what is the right policy rate to really slow down the economy. And so far, their interest rate hikes have not really had as large of an effect as they've expected. And so, they really have to kind of keep going given the inflation pressures they're seeing, even though we already know that monetary policy works with a lag, and probably some of the hikes that they did last year, their full effect is only going to be felt later in the year. So that really raises the risk that they're going to tighten to a point that's going to slow down the economy even more sharply than they want later this year or early next year. So they're in a very tricky spot of how high they can go because they're really waiting to see that actual slowdown that hasn't come in. In our base case, as I mentioned, a 550 to 575 terminal rate. We're looking for a mild recession to start in the second half of this year, and for that recession to be largely over and the recovery to have started in the beginning of next year. But as I said, if the Fed has to go even higher, I think the risks are that recession is deeper than we have in our forecast. Just to give you a metric, in the average recession in the US over the last several decades, usually the unemployment rate rises something like 2.5%. We have it rising in our forecasted recession just over 2 percentage points. So relatively mild recession. But I think if the Fed has to go higher and higher, the risks are that recession, if it happens, is even deeper than we expect.
Okay. Oh, well, that's important. So at this point, you are not expecting the banking event to have any impact on the Fed's rate trajectory.
Yeah, exactly. I think with the way, and this is a very fluid situation, of course, so it really depends on how this issue evolves in coming weeks. But where it stands now, and given the actions that you highlighted from the federal government, don't expect this to be enough to really move the Fed off of that 50 basis point hike. And, but importantly, it really does also come down to inflation this week. If inflation comes in a little softer than we're expecting, that banking issue maybe on the margin causes them to be a little more timid and maybe go with something like a 25. But given that we expect hot inflation, we don't expect any type of banking issue to prevent them from still moving aggressively going forward.
Yeah, I take your point. Larger banks are robust and have very good capital ratios. Now, your sense of the US bond yield range, the inversion range, and the dollar index as well.
Yeah, absolutely. And right now, of course, the 10-year is much lower than shorter term yields. You have that very inverted yield curve that's become even more inverted. We would expect that inversion maybe has a tiny bit more room to run, but not much more. So the 2s, 10s has been, has touched kind of 100 basis point inversion. I wouldn't expect much more of that. I would expect the 10-year to hover somewhere near 4, maybe a little bit above that. The Fed has to go higher. And then once the Fed has stopped hiking in the middle of the summer, we think the yield curve should start to steepen again. And that's usually what you see happening in past cycles, is that the yield curve gets inverted. Once the Fed is done hiking, then you can get some steepening there. But there is room again for short-term yields to move a little bit higher, and maybe that 10-year stays stuck around where it is, has been, and that inversion stays. And then for the dollar, you might get a little bit more dollar strength if the Fed continues to hike, and maybe the Fed has to hike even more than we expect. So you might get a little dollar strength in the short term, but overall, we're expecting the dollar to kind of fall in coming quarters. So we think, really the dollar trajectory going forward is a softening one. In particular, I would highlight, for example, let's take the euro dollar. Right now we think Europe is kind of going through its soft patch of growth, and the US is holding up fairly well. But we expect later in the year that the US will go into recession, and that Europe is going to be coming out of their soft patch and accelerating. So that's kind of a recipe for the euro to strengthen against the dollar. And you could tell other stories like that around the world. So I would say, the dollar story is probably a downward one, mostly from here, but you might get some short-term strength depending on what the Fed does.
Okay, well, Robert, actually, I've completely run out of time, but I have to fit in a very broad question. How does Citi see the emerging market economies in the light of all the rate hike expectations that you have?
That's a great question, and it really depends on which parts of the world you're focused on. For example, in our forecast, Asian economies tend to perform fairly well. That was true last year. We think it's true this year. So, some of the best performers in our forecast are India, China, other Asian economies, that really didn't have the same extreme inflation problems that we saw in other parts of the world, haven't had to tighten policy as much, and had a lot of domestic momentum. So I think if you're looking in Asia, the emerging market story is a fairly strong one. And I think in other parts of the world, it depends on, in part, what the Fed does. That's going to help, drive in the short term what's happening with currencies, also what their central banks are able to do. But outside of Asia, we actually have many major emerging markets going into recession or some type of low growth environment over the next year. So, for example, Brazil, Mexico, a variety of other major EMs. But I will say there, similar to the US story where I mentioned that the US recession is relatively mild, we are looking for most of these EM recessions to be fairly mild as well. So to sum up for EM, I think it depends which part of the world. But if you're looking at Asia specifically, I think those economies are going to continue to stand out as the strong performers.
Thank you very much. Thank you very much, Robert, for staying up for us and for your views. So good news as far as Asia and India is concerned. But what's staying with me is Citi still expects 5.5 to 5.75. That's 4 more rate hikes, and perhaps even 6, which means a 5th rate hike. Wrap up on Bazaar. Chartbusters up.